I've been doing some digging around into buy-to-let mortgage rates, because if you're about to buy a property or if you need to refinance, and particularly if you're coming off a low fixed rate, you need to know what's happening. This is the third video in a short series I'm doing on what the main lenders are offering in the buy-to-let market at the moment. And in this video we're going to look at the mortgage works. Now in the two previous videos I've looked at Paragon and Kent Reliance. These are the videos, and you can find them on my YouTube channel if you want to go back and look at them, which you should if you're thinking about remortgaging or if you're thinking about buying. Now before we start, and I have to say this is not financial advice, so please do take proper advice before you do anything in property investment, particularly if you're going to take out a loan or a mortgage. Hopefully you've got a very good mortgage broker who will be able to advise you, but if you haven't, more on that later, I might be able to help. For full transparency, I do have a buy-to-let mortgage with the Mortgage Works, who by the way are part of Nationwide, but please don't take this video as being an endorsement of the Mortgage Works or telling you not to borrow with the Mortgage Works. As I say, you need to take very particular advice from a mortgage broker, somebody who's an expert in the mortgage market who can take you to the product which is exactly right for you. But if nothing else, hopefully this will give you a guide as to what's happening in the lending market at the moment. So that we can compare like with like, apples with apples, for all the lenders in this series I've looked at a purchase mortgage on 75% loan to value for a limited company. And this is what I found. The Mortgage Works are offering a 2-year fixed rate at 4.89, reverting to 8.99, and that comes with a 3% fee. Or you could take the 5-year fixed rate, which is at 4.99%, also reverting to 8.99% as things stand at the moment, again with a 3% fee. What I couldn't find on their website was a standard variable rate mortgage, but in this day and age with fixed rates that low, I'm not sure why anybody would take a standard variable rate, but there could be good reasons, and that again would be something which you need to talk through with a very, very good mortgage broker. But as with all lenders, there's a number of different products and different permutations of products, and I can't possibly go through them all in this video. So please do go and have a look for yourself. For example, there were other versions of the 2-year fixed and the 5-year fixed. There's a 2-year fixed at 5.39%, again reverting to 8.99%, but this time with a £3,995 fee. Now, of course, whether that's a high fee or a low fee, of course, we don't know. If you were going to take the other mortgage, which had a 3% fee, it all depends on the value of the property you're buying. And similarly, there's a 5-year fixed, which is at 5.34%, again reverting to 8.99% with the £3,995 fee. But there's other permutations of 2-year and 5-year fixed rates as well with different fee levels. So please do have a look. Even better, take advice from a mortgage broker. If you've watched my other videos, you'll know that my concern is these reversionary rates. To be fair, 8.99 is very, very slightly lower than the Paragon rate, which is 9% from memory. Was it 9.1? They're all much of a muchness. The thing which strikes me though is that it's a lot of money, and it potentially could cause quite a lot of damage within the buy-to-let mortgage sector, which I'm sure the lenders don't want to cause. But for many borrowers who are coming off much lower rates, sure, yes, they can plug into the lower 2-year or 5-year fixed rate to start with, but a reversionary rate at 8.99%, I'd argue, is probably not sustainable for most people. Most people have not bought a buy-to-let property which could pay 8.99% mortgage plus all the other costs involved. Now the argument is, of course, twofold. Firstly, you could take out the 2-year fixed or the 5-year fixed, and then at the end of the term you could refinance, and you could refinance to another lender, and you could take out maybe a 2-year or 5-year fixed at the equivalent sort of lower rates and not end up on the reversionary rate. And I totally get that. That is absolutely true. But what if you can't? What if something happens and the lenders decide that they want to restrict their lending? What if they're only going to offer a 60% loan to value and you've got a 75% loan to value? What if in 2 years' time or 5 years' time their criteria has changed and you don't fit the criteria? Or maybe you fit the criteria but your property doesn't fit the criteria. Anything can happen. Now, is it likely to be like that? Probably not. But it could be, and that's why I think thinking about this now and planning ahead just in case is the wise thing to do. But of course the other thing that could happen, and maybe it should happen, if you've heard what I've had to say about the economy and the way things are looking, I'm not convinced that in 2 or 5 years' time the economy is going to be booming, and I think it's highly likely that by that time we will have seen rates coming down. But who knows? I don't know. I'm just some guy on the internet. I've got no idea what's going to happen. I don't fix policy. If I was fixing policy, maybe I'd bring rates down, but I don't. And it could be that rates are actually even higher than they are now. What if we have a spurt of inflation and the Bank of England have to put up rates? What if the bond market, the gilt market, yields on the money market just go up and up and up? And that decides what the lenders are going to have to charge on their mortgages. All of this could happen. Now, is it likely? I've no idea. But even if we assume it's not likely, it is still possible, which is why we need to be thinking about this. So if you're buying a property, then you particularly need to be thinking about what you're going to be doing once you come off the end of your fixed rate period, assuming you're taking out a fixed rate when you buy, and I assume you probably would. But again, you do need to take advice from a very good mortgage broker, and not from me. But if you're going to the end of a fixed term, even more reason to take proper advice, because you're going to be presumably, even at 5.39 or 5.34 or whatever the rate is that you get, you're going to be jumping up. But you want to make sure that you don't get trapped into the product in 2 or 5 years' time that's going to revert to the equivalent of 8.99 or 9% or 9.1% now. So if you do have a mortgage broker, then please do talk to your mortgage broker. Really, really important. Don't go by anything I'm saying. If you do not have a mortgage broker, I'll be very happy to introduce you to my very, very good mortgage broker. All you need to do is email me, thepropertyteacher@gmail.com, thepropertyteacher@gmail.com, and it's important that you do email me. Don't send me a private message. Don't leave a message in the comments below. Please do email me, and I'll be very happy to make the introduction. And by the way, if you want advice on anything, if you want advice about anything to do with property finance, whether that be for buy-to-let, whether that be purchase or refinance, or whether it's for bridging loans, or whether it's for development finance, whatever it happens to be, please do email me and I'll put you in touch with my mortgage broker. And if you're enjoying this video, then please don't forget to like, follow and subscribe. And please also come over to my website, thepropertyteacher.co.uk, that's thepropertyteacher.co.uk, where you'll find loads of resources, including free special reports, plus my very popular The Successful Property Investors Strategy Workshop and the Successful Property Renovators Workshop.